So here's something I see all the time. When people start looking at life insurance, the very first question they ask is, what's the cheapest option? And look, that's understandable. Nobody wants to overpay for insurance, but focusing only on price without understanding what you're actually buying can lead to decisions that don't hold up well over time. And in some cases, that can create gaps in protection or missed planning opportunities down the road. I'm Kris Dureau, a licensed insurance advisor with Harborfront Estate Planning Services, Inc. In this video, I'm going to walk you through how term and permanent life insurance actually work, where each one may make sense, and how to think about this decision in a way that fits your broader financial plan. Term life insurance is the simpler of the two. You choose coverage amount, set period of time, typically 10, 20, or 30 years. If you pass away during that period, that death benefit is paid to your beneficiaries. If you outlive the term, coverage ends because it was designed strictly for protection during a specific window of time. Term insurance is generally the most affordable way to obtain meaningful coverage, especially earlier in life. Permanent life insurance, well, that works differently. It's designed to last for your lifetime, not just a fixed amount of term. In addition to the death benefit, many permanent policies include a cash value component. A portion of your premium may accumulate inside the policy on a tax-deferred basis, depending on how the policy is structured. In some cases, that value can be accessed or used as part of a broader planning strategy, subject to policy terms and tax rules, of course. Because of these additional policy features, permanent insurance typically costs more than term insurance and is usually considered in a longer-term planning context. Rather than focusing on exact numbers, here's the key idea. For the same amount of coverage, term insurance is generally much more affordable, particularly at younger, healthier ages. Permanent insurance, on the other hand, requires a higher ongoing commitment, but provides lifetime coverage and additional planning features, basically extra bells and whistles in the policy. So the real question isn't just cost, it's what role is the insurance meant to play in your overall plan. For someone in their 30s in good health, term policy providing meaningful coverage may cost tens of dollars per month, while a permanent policy providing the same death benefit typically requires a materially higher ongoing premium, depending on the policy design. These examples are illustrative only. Actual premiums vary based on age, health, insurer, and policy structure, and should be confirmed through a policy illustration. Okay, so let me walk you through a simple example I see all the time. Imagine someone in their mid-30s. We'll call him David. He just bought a home. He has a young family, and his income is what supports the household. Now, when David looks at his life insurance, he's often comparing two very different options. One, term insurance, which provides coverage during the years when his financial obligations are the highest. The other is permanent insurance, which is designed to last for the whole life and may include additional features like cash value. The instinct for many people is to assume that permanent insurance must be the better option because it lasts longer. But that's not always the right way to think about it. At this stage of life, David's biggest financial risk is tied to a specific window of time, the years when his family is dependent on his income for that family's lifestyle and way of life. So for many people in that situation, the focus is on making sure that the risk is covered in a way that is practical and sustainable. That's the most important. In other cases, someone may choose to pair coverage with savings or investing outside of the policy, depending on their priorities and discipline. The key point is that the decision isn't about which product is better. It's about which approach aligns with the problem you're trying to solve. Term insurance is commonly used when your financial obligations have a clear time horizon. For example, a mortgage, young or financially dependent children, income replacement during your working years, business loans with a defined repayment period. These are real risks, but they don't last forever. As those obligations are reduced or disappear, the need for a large death benefit often decreases as well. Term insurance is designed specifically for that window of time. It can also make sense when budget flexibility really matters. Getting the right amount of protection in place is often more important than choosing a more complex solution with bells and whistles that may not even be sustainable long term. Some individuals choose to pair term insurance with disciplined saving or investing outside the policy. Now, whether this approach is effective depends on consistency, market conditions, and the individual circumstances. Permanent insurance isn't about being better than term, it's about being different. It may be worth considering in situations like supporting a lifelong dependent, estate planning where liquidity is needed at death, planning for taxes that may arise when an estate is settled, situations where registered accounts like RSPs and TFSAs are already fully utilized. In these cases, permanent insurance can play a role in certain estate and tax planning strategies when structured appropriately alongside other planning tools. In many cases, the cash value inside a permanent policy grows on a tax-deferred basis, and life insurance death benefits are generally received by beneficiaries on a tax-free basis, subject to policy structure and current tax legislation. One important point that gets often missed is this: you don't always have to choose one or the other. Many families use a combo. Permanent insurance is a long-term foundation, with term insurance later on during the years where obligations are the highest. That kind of structure can provide flexibility as your life and financial situation evolve. The biggest mistake I see isn't choosing term or permanent insurance. It's choosing coverage without being clear on what problem you're trying to solve. Insurance works best when it's aligned with your family situation, financial priorities, and your long-term goals. If you'd like to have a conversation about how these options might apply to your situation, you can book a time using our approved scheduled link. I'm Kris Dureau with Harbourfront Estate Planning Services, Inc. Thanks for watching.